All right, I think it's streaming somewhere. I don't know what's going on. Come on, YouTube, what's going on? Let's see. Is anybody here? Let me try to see where it's streaming to, and maybe, yeah, so I guess there's going to be 3 or 4 streams, but all right, well, anyways, let's get on with it. We don't have a lot of time. Sorry, there's a glitch in the matrix somewhere, but happy Wednesday. ADP, baby. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne McDonald. Oh, yes, I have a green vest on. It's not a real green vest. That's cruel. So anyways, we have ADP. It's another measure of employment. We have non-farm payrolls at the end of the week, so people often look to ADP as maybe a sign of what's going on in the world, but it's not necessarily true. But we will get volatility in less than 4 minutes or 5 minutes. Tema wants to do buy gold or sell news now. Neither. Okay, cool. There might be a get rich quick channel for you, but no. Anyways, so that news is coming out. We will get some volatility, all of that kind of stuff. If you look in the description below the video, there's links to resources that you will find helpful. For example, I will be using the Trader's Way MT4 platform today. If you like my tools, guess what? Go to tradersway.com and get yourself an MT4 account, for example. So all those links to the description are below. And by the way, if you go to Investor Bootcamp, along with your $88 annual membership, you also get all my MT4 and MT5 tools included with the $88. So there's hundreds and hundreds and hundreds of tools that get installed into your MT4 if you want. So very cool. I also want to let you know, today at noon is the second installment of the stock trading course. And most people don't even know I'm doing one. I've been a lousy promoter and salesperson. The first session was last Wednesday, and it was an hour and 45 minutes. And today we have another big one. It's a doozy. And so we're going into, the next segment, and we're going to start picking some stock. So anyway, so if you want to join us, that's today at noon. If you've already signed up, it's today at noon. It's today at noon. I'm going to try to find time to actually send out an email. Yeah, can you imagine? I'm actually going to send out an email and promote it. But the stock trading course is live. It's happening. It's real. Few minutes till the stock market opens. Bitcoin turning north off of the M2. Sorry, is that M2? M3. Sorry, using M3 as support, but it's a roll reversal. You can see there. Oil continuing its downward course, probably around 85-ish. Should be the bottom on that one. Stock market is trying to head up. I don't believe it yet, but that is one of the numbers. Remember 4,200? We picked that out 2 or 3 or 4 or 5 weeks ago as a potential bottom. So it's down there now. That's kind of hopeful. But remember, it's going to depend on ADP. It's going to depend a lot on ISM services, for example. It's going to depend a lot on non-farm payrolls on Friday. So we got a lot of work to do yet. Okay. And it looks like people have logged in. That's really good. I don't know why I had streaming software. What I did is I rebooted it. So it was streaming to somewhere, but nowhere particular at all. So anyways, I'm glad you found it. All right, so ADP, another dumb prediction. This is different from non-farm payrolls. Non-farm payrolls is a government agency doing stupid math and guessing on how many jobs were created in the economy. This is a private company that provides payroll services and benefit administration to medium-sized companies, small and medium-sized companies. Companies that have multiple employees, but not so many employees that they need an entire HR department. So they outsourced the HR department. Cool. So now we can just count the stubs that they process. ADP. And yeah, probably just a few seconds now. Let me get the number for you. I got to click on this. I got to click on that. Should be out any second. It's coming out. It's coming out. Okay, it was 177 last time. Should be closer to $1.50 this time. Wait for it. Wait for it. Wait for it. And 89? Is that right? 89? Oh, that's horrible. That is such good news. Yeah, baby. Go. Run, Forrest. Run. Yeah. Very cool, man. Very cool. All right. So 89, way below expectation. And that's good. Why is that good? It's a sign. It's a sign that the Fed doesn't have to raise interest rates too many more times, that the economy is actually cooling. So that bad news is good news. Yeah, baby. Very cool. Okay. Very cool. Very, 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 very cool. It's a beautiful day. Okay, skippity scalpers, maybe. Are you going to get an opportunity? Oops, didn't mean to do that. Don't get away. Doing too many things at once. Come on, Wayne. Okay, cool. Morning, Maida. Alice, a good revision. What revision? I looked at it too quickly. Yeah. Okay. Once again, everybody, while this is happening, I got to remind you, because I keep reminding myself, oh, there's so much going on. I'm doing a stock trading course at noon. Oh, it's only a few hours away. I'm going to try to keep it under an hour and a half. I don't think I'm going to be able to do it, though. So I have too much to tell. And I'm trying to build a really good base. So today, you're going to be, we'll see how much the developer was able to do overnight. But last night at like 10 o'clock at night, I was sitting outside in the dark with my laptop, taking notes and sending them, add this and add that, add this and add that. And so now he's worked another 8 hours on this presentation, and I just got it now. So as soon as we're done, I'll be back outside. So it's a lot of information, but I'm setting this foundation so you can start picking stock. It's a stock trading course. So we will look at many examples, and you will tell me based on your quantitative analysis whether it's a good buy or not. Oh, well, I think it's going to go up. That's dumb. Why'd you buy that stock? I think it's going to go up. Come on. We're going to get into it, man. We're going to get into it. The trick is for me to teach you how to do it without the wonky math, but I have to show you the math. Yeah, I'm going to keep it as light as possible, math-wise. But you get to show off for your friends because you get stuff like this going on, huh? Where you got, right? And we're going to cover stuff like this. And eventually we're going to get into stuff like this and stuff like this. Nice. Greek letters, good. All right, there's your pullback. Shields up, red alert. Shields up, red alert. Trying to zoom in. Shields up, red alert. Well, there's more to it than value, or even real value. There's more to it than that. Okay, there's more to it than that. I mean, a lot more. So, we'll cover it today. What's up, Cream? All right, shields up, red alert. Right on the 618, right on the roll reversal. This is bad. Don't do this to me, stock market. Don't do it to me. All right, let's go out a little further. Okay, reaction over reaction. We hit the central, right? We hit the central. We hit the October... no, we hit the weekly central, and it held. No way. Come on, man. Don't do this to me. Come on. This should be good news. The bad news is good news. We ran right into 42.46, and it held. Okay? But this should be an up. Don't you stink? Bernd is like, that's why I'm in the course. Right, of course. Now, Richard hits the nail on the head. So one of the things we're going to cover today is the expected return. Yeah. Oh, so Richard, I'm going to have to start with that and then add a layer, then add a layer. And then I think the next one's going to then lead into CAP-M. I have to do a CAP-M. Oh. Okay, we got the roll reversal. Come on, Bubba, hold. Turn the green, turn the green. Okay. Yeah, baby. Come on now. Giddy up. Get up there, Bubba. Bum, bum, bum. Come on, Bubba. Get up there. Giddy up. So, yeah. So, how interesting is that? Bad news is good news. Now, if you watch the Quant-in-a-Box video, did I upload it? Dang it. Maybe I didn't upload it. Didn't upload it. Man, too many things going on. In today's Quant-in-a-Box video, how about that? Let's see if I schedule something. I didn't do it. Do I have the file though? Did I download it? Today is, yeah, so I have it there, but I just have to log in. Okay, I'm going to try to do this while I'm talking. I need to get that Quant-Box video up for you. So one of the things I talked about is I gave you a little hint about some of the content that we'll cover today in the stock trading course. And it's statistical analysis that I want to teach you today. So statistically, you can pick the best. Now, I'll define what that means. But the best investment out of various choices. So there's all kinds of things that we need to look to be able to do that. We have to look at a lot of different things. And expected return for sure is one of them, yeah. But is that enough? No. Not at all. Remember, I'm leading up at some point to teach you how to do portfolio construction. So there's a lot of things that we need to cover before we get to that point. And obviously just buying random stocks because you think they're going to go up or you think they're going to make a lot of money, or even, you know, a lot of people do things like, I bought it because it has a big dividend yield. Well, that doesn't even make sense. Oh, how can you join? Sorry, I thought I posted that. Is it here? Yeah, it's this one. Yeah. So, so Jason says CAPM, not yet. So that's what's next. So that's why I'm setting things up, right, Jason? So at that, I want to cover expected returns, and then we're going to have to do variance, standard deviation, and all that kind of stuff. And then I'll introduce beta, because that's the next thing, right? So I thought as I was developing these examples that we could also then roll into that model and do a CAPM. Okay, so that's where you get, delete. That's where you get the expected return of a stock is equal to, right, the risk-free rate, okay, plus the beta, okay, of the market, okay, which is the expected return of the market minus your risk-free rate of return, because that's your opportunity cost. At least this is how I think of it. You know, a lot of people go over CAPM and explain it completely different than I, but this is how I think of it, okay? So like, before we get in there, you know, you're going to need to know, well, how do you calculate the expected return? Well, you can use this to calculate the expected return, but you can also reverse engineer all this. So I want to cover expected return first, mathematically or statistically, right? And then we can do all of this stuff later. So, you know, the next one will probably be a quickie on CAPM. Okay, hang on. Where'd my drawing tool go? Where did it go? I've lost my drawing tool. Anyways, I'm going to switch over to a Fiverr. Oh, here it is. I found it. Yeah, they have some weird upgrade now, which snaps it to the edge of my, and I can't control it. The snap is terrible. All right, so this is terrible, actually. We're still not really through, but this is not a good sign. We're breaching the price action. I mean, maybe I'm zoomed in too much, but no, that's an important level. The 15-minute 21 is way down there, and the 15 candles on the 5. So it's okay now. Like, this was your last purchase opportunity. And I don't really want it to come all the way down here and then head back up. I really don't. But that is forming a hanging man. So I'm going to mark the lowest low of the current candle. No, I'm going to mark the lowest low of the previous candle. Let's do it that way. And then drop back into a fiver. So we really want to stay above that. So I'm going to even put it on a 60-second chart. Okay. Well, Frank says he did that on financial management, but never to apply in the financial markets. Well, the thing is, you need to understand these concepts before we start choosing which stocks to buy. It would be negligent for me to do a stock trading course if you don't know how to quantify risk. So we got to cover risk from top, bottom, left and right, upside down and inverse and out, right? We got to, right? So we got to cover all of that. So like once you understand cap M, well now maybe you don't use cap M in a practical sense to pick a stock, but you understand the concepts of expected return, and you understand the concept of beta, and now you're right. And I want to lead up into things like well, we have to cover probabilities, we have to cover variance, we have to cover standard deviation, so that later on when I say when I offer various stocks for you to choose from, you're like, look at that, and you point to something that I've taught you, and you say, on the surface of it, I wanted to buy this thing, but oh God, look at that. No way. That's what it's about. Right? Statistically, you're like, that doesn't fit my risk profile. That's not what I'm looking for in my portfolio. And that's right. So it's all a buildup. Okay. All right. So this is terrible. Come on, get up there. 786 pullbacks are bad. But remember, this is just the previous 15-minute candle. So, I mean, it's really nothing. The next thing that you want to mark is you got to go out to like the 15-minute 21, which is down there. And if you want to try to get cheeky, be a cheeky little monkey, you want to throw in the zero lag 21. And we'll make it a fatty. Or should we make it a scatter, a dotty? We can make it a dotty. It's harder to see. All right, well, let's drop in. No, let's zoom in. That's the wrong way. Zoom in, Bubba. It's not much different. So currently, what price is that? 42.30, huh? So that says it's going to come down to that level, which is that one. So the 15-minute chart is taking that low to that high. I guess so. I would have wanted more than that based on high volatility, event-driven strategy. But if that's come and gone, then the next trade is this one, not that scalp. But what the lag is telling us is it's that role reversal there. So think of this as, we've made a 3A2. Let me get rid of the extension. We've made a 3A2 already. Okay, so let me mark this up. Okay, and the next, so this either holds. Okay, there's two probabilities, right? Or should I say possibilities? Okay, this is still the continuation of the first trade plan that I set up on a 5-minute chart. Okay, that's a 382 with an extension. The other one is the same trade essentially, set up on a 15-minute chart based on a price action roll reversal at a 618. So it's an A and B scenario, right? So it's binary in the sense that there's two setups, but it's not binary in the sense that you're a bull either way. Okay. Okay. You know what, Jason? I would definitely do the London School of Economics. I taught an executive MBA class at Georgia Tech University, which is, I think, the second or third highest ranked engineering school in the world. And I did a lecture on trading and investing. But yeah, so not a problem. LSE, I would definitely do that, Jason. Set it up. Let's do it. Wayne at fxbootcamp.com. Richard says, do we have to calculate beta or do you just have to figure it out using math? Nobody does the math. You just look it up. Yeah. All right, everybody, we're going to London. We're going to do a meetup. We're going to do a meetup in London. Jason's going to set up the meet with the Trading Society at the LSE. We'll go to a nice place after our discussion. Yeah, Darko's in, Jason. Come on, Jason. Everybody's waiting already. Come on, Jason. Okay, let's go back to the 1 minute. Okay, still looking okay. This is reverse fib territory, but you know. Hey, Darko, we can meet up in London and then go sack York like William Wallace. Yeah, Richard, making the sense of it all, of course, is the ultimate value, right? And I've said it before, but, you know, I seriously considered a PhD in economics, and the closer I got, the less I wanted to do it. Yeah. Because it got too mathy. And it didn't make any sense anymore. It just became math. And I'm like, ugh. I mean, there's definitely math in it. So one of the things I'm really enjoying in this course is trying to teach the math without getting mathy. So the whole time you have to think about what's the point? What's the point? What can I get to? Some of it I'll have to teach you the math. Some of it I'll just show you the math. But ultimately, I'm trying to show you the math just enough so you understand how we got to the number. And then I want you to know the importance of the number so that when I show you 3 investment opportunities, you're like, well, A, definitely not. B is okay. C, oh, no. And then you go back to B. B is my choice. And I say, why? And you're like, for example, oh, well, based on, let's say, risk-adjusted analysis. Okay. So, and it makes me think of, like, I did that class at Oxford on algorithmic trading, and one of the final exam questions, I think there was only 2 or 3 questions, but it was like, analyze these 3 algos. Which one do you invest in, if any, and why? And another one, I did 2 or 3 classes on real estate. And I almost did one at the London School as well. There's a real estate program there. But anyways, I didn't. In one of the final exams for real estate, it was, look at these 3 projects, 3 different apartment buildings or whatever it was, right? Look at these 3 different real estate projects. Which one do you undertake and why? Okay? You see what I mean? And it's the same type of question, whether it's real estate, stocks, Forex, commodities, or combinations of them. These are all things that we need to understand. So that's why I'm starting with financial markets leading into choosing stocks. And I've also motivated myself, as soon as we're done the stock trading course, I'm going to do a bond one. I'm going to do a bond course. I'll do it, maybe even by the end of the year or early next year, I'll do a bond course. I think it's just, once you capture the beginning, then you got to, once you do stocks, you got to do bonds. And then I think when we're done bonds, we'll do real estate, because what's real estate? It's just a bond. Did you know that? An apartment building is just a bond. So if I'm going to teach you how to do bonds, next step is real estate. So I think that gets us to next summer, right? So summer school in 2024, we'll do real estate. Cool. All right, come on, this is it. Because this is the reverse fib, right? So we're right in the middle of fib wars. For those who are fairly new, I'll show you what I'm talking about. This is where bears sell, and bulls already bought down on plan A. So if a bear's going to sell, they're going to sell soon. If not, this is just a nice little scalp. Yeah, so I gotta send an email because people don't know I'm even doing the course. How crazy, huh? Well, 10 years typical. But these are variables. You can use whatever you want. But 10 years, quite typical. All right, there we go. Come on, Bubba. Giddy up. Looks good. Looks good. How far are we from the open? Oh, it's another 45 minutes. Oh, it's forever. By the way, no one was injured in the creation of this green sweater vest. It's not a real green sweater vest. That's cruel. You have to be Canadian to understand that joke. In particular, a Canadian that was 20 in the 1990s. Yeah, Jason talks about like systemic risk and stuff. Yeah, there's different types of risk, but that's why you got to understand things like what's the risk of this choice, but what's the risk of the market in general. Now, when we get to the next step, by the way, this whole course, the reason I haven't even promoted it, the reason that nobody knows it, is I started a group called the Council of Investment Advisors, and it's about portfolio construction and management. And I'm teaching these concepts, right? Or I need to teach these concepts so we can discuss a real portfolio, manage this real portfolio, invest real money, my money, but real money. And so they have to understand the concepts. And I'm like, oh my God, I got to teach all this. So now all of a sudden I'm just doing the course for the sake of doing a course. But you got to get to this point where picking a stock is risky. But the stock market is also risky. And the stock could be more or less risky than the market in of itself. And so there's all these concepts like, well, what stock should I pick in an up market? What stock should I pick in a down market? What stock should I pick in a sideways market? Or should I just buy the whole market? And then you can say, well, now I'm not being idiosyncratic with the acceptance of risk, but I'm accepting the systemic risk. So now I only have to hedge or manage the systemic risk. And where does the systemic risk come from? So then I got to obviously do business cycles and monetary policy again and bring all that back. You're like, oh my God, right? Like then you see how interesting and complicated it can get, but to me in a lovely way. These are the right things to be talking about. And so I'm hitting all these things as we go, and I'm not like teaching a course. I'm following a path of logic. And I know where I want to get, but as you follow, then I'm like, well, I guess I got to do CAPM next. And then I teach CAPM next so that you understand the beta. But before I teach CAPM, I have to teach expected returns. But if I'm going to do expected returns, then you got to do standard deviation. And all of a sudden you're like, oh my God, right? And so you go to here and then you go back and then you set it all up. And to me, it's incredibly interesting. Okay. Richard, if you were going to make an investment for 10 or 20 years, would you care about the volume? No, probably not as much. If you need it to go up today or tomorrow, you probably do. But I'm going back to like idiosyncratic or systemic levels of risk. I would isolate my investment choices so I don't need like volume analysis. But yes, but no. Okay. But if you were going to, but yeah, I mean, yes and no is yes and no is the actual real world answer. Okay. I mean, you can't do it with no volume. How about that? Because you could also, like, it depends too, like if you're saying volume over the last few hours or the last few days, another way of looking at volume would be liquidity. Now, if you had said liquidity, I'm like, well, I don't want illiquid assets. I'm going to leave that for hedge funds. Do I want illiquidity in my portfolio? Do I want illiquidity in my portfolio? No. But would a hedge fund manager want illiquidity in their portfolio? Well, yes. Okay, because those are frictions, and those frictions allow for alpha. Because that market is not efficient, right? Yeah. Yeah, dark is like most of it why we need it. Well, it's actually, you almost got it right. You got to start with the probability first. Okay? From the probabilities, you get expected returns. From expected returns, you can then get, you have to do the variance of the expected returns. And then from the variance of the expected returns, you can get the standard deviation from the expected returns, right? And so, yeah. And if I taught that math class, I would walk in on the first day. I'm like, who wants to get filthy, stinking rich? Who wants to make money? Right? Everyone's like, me, good. Well, today we're going to cover probability, standard deviation and variance, right? Or the other way around. Probability, variance, standard deviation. And then, of course, from that, you would also do linear regression, and all of a sudden they're like, man, you're going back to math again. Uh-huh. All right. Next pullback. Oh, that's interesting, Peter. Yeah. That just came out right this second? Where's my ripple? There it is. Yeah. Well, it looked like it came out a few hours ago, huh? Oh, wow. Okay. Yeah. So look at expected return and variance. Can you see it? So then you'd calculate the standard deviation and you would say that asset has a lot of volatility and therefore risk. Does it mean good or bad? No, it means you can analyze and quantify this stuff and then make a decision. Do you want it in the portfolio or not? Okay, cool, right? That's how you do it on a chart. You can also do it in a table. Either way, it's really interesting statistical analysis. So anyways, there's the new buy the dip for the skippity scalp. We'll see how that's going. Oil stabilizing on the M2, monthly M2. Gold doing the double bottom. Notice that it's above the hourly projected 21. It topped out on the 55. It'd be interesting if it makes a higher low, higher high. That's risk on. That's risk on. Okay. This is risk on. I can't believe it. Pumping on my chest and I'm screaming. I stopped breathing. Damn, I see demons. Dear God, I want you if you can save me. I can't die, my boo's about to have my baby. Yeah, we got risk on across the board. Okay, yeah, a little weakening there. That's interesting. Pound, look at that one. Oh, nice. Oh my God, this feels so good compared to yesterday. I hope it lasts because that's the kill zone right there. That's a kill zone, but even then I would have to mark this up. Okay, and you know, by kill zone, what I mean is down, up, down, and then maybe up. What do you stink? Smell like a plan? Richard says, Excel. The thing is, Excel is a skill in of itself. So, yeah. So I'm trying to do all this without doing that. But that is the logical next step. Okay, so that's great. Kiwi dollar. Maybe a double bottom there. Let me flip it. Very cool. So that's good. Okay. Yeah, look at that. Just skimming off the atmosphere, huh? Next real challenge is in there. Let's go a little further out, maybe hourly. Yeah. So we're in resistance. So probably something similar where it's got to come up, breach that, and then come down, and then work its way up, and then come down, and then work its way up. Off of that. Cool. Very, very hopeful. Well, Brenda, I don't want to, as your guide on this journey, I don't want to make that part of the course. I want this so anyone can do it. The logical next step, though, of course, would be that you would build an Excel model. I can even get some models for you and just give them to you and like, hey, play with this. But I don't want it to make it a point of the course. I don't want anyone scribbling down formulas and stuff. It's not a financial analyst course. I want you to be able to understand. So when you're looking at stocks and there's, let's say you've got some sort of screener and you have a bunch of stocks on your stock trading platform, and you're like, oh, I can throw in a column for like standard deviation. You're like, and now you know what that means. And so you can look at it and go, oh, these are all stocks I'm interested in buying. And then you're like, oh, maybe I'll sort this by standard deviation. And why? Why would you do that? Well, you know why. Right? Well, the point is that you understand them, right, Bernd? And there's relationships. So like if we're doing monetary policy, right, I'm going to do 1 over R plus E, right? And you're like, oh, that's the money multiplier. But you'll see a lot you'll see similar formulas. Like, so you can say that is the money multiplier. Okay. Okay. But that's what an economist would think. Now, you might get something very, very, very similar, and we might be talking about finance, and you would not call it a money multiplier, and nor would it be required or excess reserves, but you would see like, you know, I don't know, this isn't an actual formula, but, oh, sorry, I can't think and do two things. Right. You know, for example, 1 over the expected return or something like that. Minus 1, right? All of a sudden you're like, well, how do you get to all of this? And you'll see similarities where 1 over R, okay, that's probably better. 1 over R in finance and 1 over R plus E are very, very similar, and they're used to get to a certain outcome, and there's similar outcomes. The magnitude. Now, is it the magnitude of opportunity, or is it the magnitude of risk? Is it the magnitude of return? Okay, but you'll see you'll see the combination of economics and finance, and so I did both. And a finance-only person might not make the connection, and an economics-only person might not make the connection. But even if I don't understand what the connections are, I see them, and I'm like, ooh, okay. So anyways, we'll see if we get back up there. The predicted pattern, by the way, based on the training course at investorbootcamp.com, okay? The training course says, if this occurs, this is the target. Cool. And if it happens early, you can get a counter trend, which tells us this. So if that's in play, we got to go up. We're going to respect this. Why? Well, that's why we have it there. So then we'll get it down, and then we'll call it a double bottom. Then we're going to get this. Probably respect that. Then we'll get that, and then we'll get this, and then we'll get that, and then we'll get that, and we'll end October around there, maybe. Okay. I like Excel, Richard. I don't love Excel. So, like, put it this way. I got all that formal education late in life. So if I was 20 and I was in university, I'd be throwing myself at at Python. I'd be throwing myself at Excel. And yeah, I'd master it. I'm capable, but I'm nowhere near a master. I'm barely capable, but I'm capable. I mean, I've obviously done it. I can do cash flow statements and stuff like that, right? But am I an expert in Excel? No. If I was 20, I would become one. But look at me. I'm the boss. So I don't do that kind of legwork. So like I could just hire a quantitative analyst to gather all the statistics of the economies around the world, crunch them, and give me reports. Well, instead of hiring a person, I built Quant-in-a-Box. What I need is the number. Tell me the number. So again, going back to a course, am I going to do an entire course on Excel? I'm not a financial analyst. I'm an investor. So I don't know. I'm not going to do, because that's like, for lack of a better word, that's the grunt work. Now, it is fascinating. I do love it, and I can get caught in doing it, but I just don't. So no, I'm not going to do the Excel course. But you can and you could. If you have those skills, you'll love it. Because calculating standard deviation, it's just a function, right? Because now you got the square root, and then you type in the formulas for the variances. So you take the probability of this and take this expected return and the probability of that plus the expected return of this and the probability of that plus the expected return of the third times the probability, right? And take that and then square root it and it'll give you that standard deviation. I just what's the standard deviation and why is it important? So that's all I'm going to do. So no, I'm not going to do the Excel, but it's interesting if you're into that. Okay, I'm too old and too pretty for that. Oh, it's after 9. I got to roll. I got to move. Give me the juice. Let's quickly go back to that. I think it was the S&P 500. Let me go back to the commodities page. Okay, and we're right back to where we were. That's too bad. All right, so we're back onto scenario A. Well, the market's not even open yet. All right, cool. So are you guys going to join the course? Who's going to join me at noon to do the second one? I'm going to spend the next 3 hours preparing for it because I just got back the last deck from the PhD working on the project with me. So I'm like, do this, and do this. So he's done it. Now I got to go check it. And then I got to figure out how to explain it, right? So the stock trading course, I don't know how long it'll last, till the end of the year maybe? So every Wednesday at noon, we're going to do another lecture. So this one, like I said, we're going to be picking some stock, comparing some stock. Next one, I'll probably do the capital asset pricing model. So we've already done some valuation models, and I have to do that. So I want you to understand beta. Okay, so we're on a journey together. I don't have 16 weeks planned out. I just know where I want to get you. Okay? So we're going to tackle one thing at a time. So here's the thing. You should sign up right now. Meet with me live at noon. While you wait, there's an hour and 45-minute lecture that I've already done. This is week number 2. So you can watch that lecture. So, maybe you don't understand the difference between a commercial bank and an investment bank. Oh, well, you will. You will by noon. Okay? Cool. Well, I got to run. I will see you at noon. I hope to see you there. Peace on earth. May the pips be with you. May your profits be above average. Yeah, noon. I'm going to try to send an email. I forget. I'm going to try to send an email, but it's noon. So where's the page? Hang on. Let me pop that open. Noon. See, look, he's actually doing analysis. Yeah. Oh, there it is. Meet Wednesday at noon. So it'll be at noon. When will it be? Noon. Boop. Sky Killer likes the, yeah. The trick is I got to show you the math, but I don't want to make it too mathy. But I have to show you the math so that you understand what the number means. And once you boil it down to like, is that you want that to be a big number or a small number? Okay. But you still need to know how the math works so that you comprehend what the number actually means. Okay. Yeah, Burns like, I'm not looking at all my emails all the time. Yeah, well, it's noon. Cool. Right on. Well, I will see you. Have a wonderful day. And the video for Quant-in-a-Box has been uploaded in the background. I think I finished it. Hang on. YouTube.com Quant-in-a-Box. Let me just... yeah, I did it. Cool. So that's 6:30 in the morning. So that's released in less than an hour, just so you know. Peace on earth. May the pips be with you. May our profits be above average.